Ever wondered who's behind the scenes managing the U.S. economy, ensuring our financial system stays balanced and keeping inflation in check? Meet the Federal Reserve System, the backbone of America's financial stability. To understand the Federal Reserve, or simply the Fed, we need to rewind to the early 1900s. The U.S. faced frequent financial panics and bank failures, leading to a pressing need for a centralized banking authority. Enter the Federal Reserve Act of 1913, signed by President Woodrow Wilson. This act established the Federal Reserve System, aiming to bring order and stability to the U.S. financial system. So, how is the Fed structured? The Federal Reserve is not just one entity, but a system comprising 12 regional Federal Reserve banks spread across the country. Each regional bank serves its own district, providing a unique perspective on economic conditions throughout the nation. At the heart of the Fed is the Board of Governors, located in Washington, D.C. This 7-member board oversees the entire Federal Reserve System, guiding monetary policy and regulating banks to ensure they operate safely and soundly. The president appoints these members, who serve staggered 14-year terms, ensuring continuity and expertise. But what does the Fed actually do? One of its primary roles is to manage the nation's money supply and influence interest rates. Through its monetary policy, the Fed aims to achieve maximum employment, stable prices, and moderate long-term interest rates, key ingredients for a healthy economy. The Federal Open Market Committee, or FOMC, is the Fed's monetary policy-making body. It meets several times a year to discuss economic conditions and set the federal funds rate, the interest rate at which banks lend to each other overnight. By raising or lowering this rate, the Fed can cool down or stimulate the economy. For instance, during a recession, the Fed might lower interest rates to make borrowing cheaper, encouraging spending and investment. Conversely, if the economy is overheating and inflation is rising too quickly, the Fed might raise rates to make borrowing more expensive, slowing down spending and stabilizing prices. Beyond monetary policy, the Fed plays a crucial role in supervising and regulating banks to ensure the safety and soundness of the financial system. It also provides financial services, like clearing checks and processing electronic payments, acting as a bank for banks. In essence, the Federal Reserve System is the guardian of the U.S. economy, working tirelessly behind the scenes to ensure stability, growth, and prosperity. Next time you hear about interest rates or inflation, you'll know the Fed is at work, balancing the scales to keep our economy on track. Thanks for watching. Stay curious and keep exploring.